So let's get into this. So obviously last week we had at the end of last week we had some interesting stuff. The the market sold off a little bit, didn't it? Of course, we're not
Yes, they
financial
did.
advisors. Everything you see here is our own educated personal opinions. Do your own research. You can't guarantee saving, making, or doing anything positive with money. But there's no guarantee you won't experience a loss when investing. What we're trying to do is just give you the tools and the education to make your own decisions here. Do your own research, though. That's what you got to do, right? Uh, okay, we're gonna get everybody, both of y'all, get into some trades, get into some all this cool stuff. Before we do that, though, I want to lay the foundations for what people might be thinking about. Why we had a dip below the, if I remember correctly, we dipped below the 20
Yeah,
20 EMA last week. So,
correct.
why, right? And then what is kind of going on in the economy? What maybe is causing these triggering these sell-offs? This is all obviously hearsay. We don't know what's causing it. The markets are a cruel mistress. We can't actually determine what's causing anything. But hey, we can have a educated guess and think through some things here. So quarter-over-quarter GDP growth came in pretty good. It was about 3%. So put it on the econ hat. Don't worry, we're not going to get too esoteric on this, but just quick for people who don't know, right? Uh, GDP, that sounds good, right? Oh, we're growing, we're growing, we're growing. Well, let's look at this. What's the GDP formula? It's C plus I plus G plus parentheses X minus M. C is consumption, I is investment, G is government spending, X is exports, and M is imports. Now, don't worry about all of that stuff. What's really important to understand for that GDP number is that when imports fall, it gives an artificial bounce to GDP. This is a pretty silly equation, to be honest. GDP in general is pretty silly, but people care about it, so let's at least understand what it is, right? If imports fall, right, it causes that little parentheses there, exports minus imports. It causes it to be bigger than it otherwise would be, right? Because obviously you're subtracting, right? So now why did they do that as this way? Well, the idea is that falling imports equals more domestic production, but that's not really true all the time, right? You can just have falling imports and no correlated increase in domestic production. So what instead you should do, right, is helpful is look at consumer spending. And if we do dive into those numbers on consumer spending, it grew at a tepid pace, 1.4% quarter over quarter. And not only that, like you're saying here, it doesn't, the value of exports, sorry, not imports, the value of exports also dropped. And if you dig into the numbers, you see business investment did drop as well. So the question is, growth is in question. I just saw a Bank of America statement today that's saying that America First policies under Trump will be tailwinds for growth, but it is in question. Well, are we going to grow? Are we not going to grow? And of course, on Friday, some more. I think this is maybe what caused more of the market sell-off than the labor data itself, right? We had the bad labor data. It was like 35,000 jobs added in a country of 350 million people, which is insane. And then Trump, of course, said he fired the secretary of the BLS. Said he was a Biden appointee. All these numbers were fake. And then said, you can see the tweet here. This was from this morning. The jobs report was rigged, just like numbers prior to presidential election. Radical left Democrats can fake numbers concocted in order to make a great Republican success look stellar. Pick an exceptional replacement. Thank you for your attention to this matter. MAGA. Okay, so we don't know, right? So either way, right? Those numbers being fake, if they were fake, if they weren't fake, if they're not fake, they're bad, right? That's not great for the jobs economy. If they are fake, well, then it makes the U.S. assets are going to be charged a risk premium because it's going to become the basis of the entire U.S. equity market plus the bond market is that it's stable and it's a knowable entity and it's transparent. The most of
But
everything, right?
another thing you have to remember, think about this. July ended Thursday night at midnight, and they put this out Friday morning, and this is July's numbers. I want to know who stayed up all night crunching them and throwing them out.
Right. Right.
So,
Well,
I mean,
it is
how
a
real
big.
are they anyway? Just with basically 8 hours of time before they had to throw them out.
That's true. And then the revisions always come in, right,
Right.
in a couple weeks, and they're always worse even than, or sometimes maybe these will be, I don't know, but the revisions are always different than the actual numbers that were thrown out. If they really can even understand any of this, as close monitor as closely as they pretend to be able to do that, we don't know. But so anyways, markets sold off, people got scared. We are recovering today. In my opinion, it was a bit of a false flag sell off. I think that uh it will become a I think this might just be a quick dip. We'll see though. But again, this is either way, right? If the US numbers are real, it's bad for the economy. If the US numbers are fake, well, that kind of like goes against the entire thing that undergirds the US bonds, US equities. Like we need to be stable. So what is going on in America? Jeff, coming at you. What do you think?
Only 58% of the S&P 500 is above their 50-day moving average.
Right. The S&P 490 has had no earnings growth since like in like 10 years or something. I saw
Yeah.
someone put
And
that
I
in.
mean, 2 weeks ago, 3 weeks ago, it was over 70%. So I think people are thinking this thing's overbought, which I think we all agree with that kind of. And I think this thing needs to have a nice little correction to get everybody back, their heads back together a little bit. They had the start of it last week. I was thinking coming into last night we would be down, and we weren't. We were actually up, and I was like, oh, okay, fine. So that things are, even perking up here. We're back above 6,300 on the S&P, almost above 6,350 now. So we'll kind of see what goes on.
being,
Um,
being led by American Eagle.
yeah.
Dragging everything higher today.
Yeah. Uh, But yeah, I
Well,
mean, just kind of looking at the numbers, the one thing about that jobs report that I was kind of, raising eyebrows at, and I mean, a lot of people don't dig into, and I don't really dig into the report, but the number of people that have been unemployed for longer than 27 weeks, which basically is 6 months, is actually going up. So there's a lot of people that have been looking for jobs for 6 months or whatever it is, and they still haven't found a job, which is kind of interesting. I don't know if they just don't want to take a cut in pay and they're trying to find something that's still higher. I don't know what the deal is with that. I don't dig into that kind of stuff, but I just thought that is actually going up as well. And then if you look at your equation, the G in that equation can go all over the place, in my opinion. I
Yeah,
mean,
that's the government spending, right?
yeah. So I don't know. I mean, granted, there's been, I mean, for the past, what, 20
but is the
years,
G
they've been
going
spending money
down?
like crazy anyway. But
Yeah.
I
I was
mean,
gonna say the G's going up. Like I
yeah,
don't think G's going down. After the pivot in April, I think G's gonna be steadier up.
yeah,
So I think the one thing that continues to surprise me is like we all know that the markets can stay, more bullish and not really reflect the economy and doesn't have to reflect the real economy whatsoever. Look, man, I don't think the US can afford to go into recession. I don't think that the US can afford to lose its American exceptionalism. Trump and company, and like, I mean, Trump's going to spin the narrative where he and the administration are going to be pro growth, pro everything. They're going to incentivize and deregulate. I think there's a reality check because we are overvalued. But in order to prevent like a run on the dollar to bigger extremes or run in the bond market to what we've already seen, like it's just we're in a 5-year bear market in the bond market. We've seen the dollar have the worst sell off in 50 years. Um, I think technically speaking, this market still needs to pull back. I'm welcoming a 2-day dip that pulled back about 3.33%. We're now just filling the gap. So from Thursday's sell off to Friday's close, now we're filling in that gap. I mean, I think the market struggles to break the highs that if we're looking at SPX there or SPY at 640 there, Alex. I think we're struggling to break 640 with like really conviction. But if we come back and fill the gap at like 632 or so, and then we just kind of putts around this week without really going anywhere. I could see this being like a take the Thursday, Friday like range. And if this week trades inside that, we'll see like where the breakout sits because we came back and finally closed below a 21 day, but there's still a 50 day. We were
Yeah.
300 plus points above a 50-day moving average, which is very rare, and that's a 4+% correction. So I
Yeah.
think at the minimum, like we still have a high to low, a pullback. We can kind of hang out in between. I think we still hit the 50-day. I think we still hit previous all-time highs. I think we hit, anywhere between like 4 to 6%. To me, that's still a shallow pullback. 4 to 6% still shallow, but that's very reasonable for what this market probably should do with a 30+% rally off the April lows. So I mean, I'm focusing on, the VIX spiked up to 21 and change last week. I think the high in the VIX on Friday was 22. So we've retreated back to 18s. I'm just going to keep selling premium. I sold some puts last week on Friday when the VIX spiked up to 21, 22. I was able to go out last week. Let me see what trades I had here. So on SPY, I think I did some SPY and some Qs last week. Let me check here. Qs and SPY. Yeah, I did some trades getting in. I've got it just in my tracker here. Sorry, give me 30
No,
seconds.
you're good.
Yeah, so I got like $5 credit. It's in my Project Options Edge. We got like over $5 credit. And it's a 98% chance profit. So I went out to the end of the year. I did a ratio spread in the SPY, got over $500 credit. And there's, it's a stock where I'm like, okay, if I own the SPY, I'm going to own the SPY at let's see, 479. I'll own the SPY at 479, which is below the April lows. And that's if I get assigned. I will take bites like that. And then also I'm watching closely for some of my other services. We pull back into the 50-day, pull back into the 100 to 200-day. Any of those moving averages that you might see on your charts that I like to use, that moving average cluster is really well supported, but I'm just going to take little bites. I think that if the market flushes down, 5%, if it gets a little bit uglier from like this July to August window, or maybe now since it was August 1st, the market kind of turned August to September window, any pullbacks, I'm going to take some bites and buy this dip. I think that the markets, I mean, we're seeing expectations getting raised in the S&P targets for the year up into the high sixes, 7,000 plus, which again, those don't mean anything. Those analysts are so terrible. They don't mean anything. But I think that this is, bullish kind of at all costs through 2025, and maybe the market faces more of like the reality in 2026 or 2027. I don't think there's any drastic.
Yeah, I really think.
Yeah, I was going to say policy change is the only thing that's going to shift this market's mindset.
Yeah.
And policy would be like the big swing would be the pendulum swinging in midterms, which is fall of 2026. So anyway, volatility, yes, but I think the market's going to be eager to buy the dip and still look at everything positive. Everything forward thinking is like positive, positive, positive. AI this, deregulation this, pro growth. And it's kind of funny money, man. I mean, Microsoft last week, the earnings on Microsoft on Wednesday were like 2 to 3 times the expected move. Like it blew off the earnings, and I was actually bummed I didn't get filled. I had a 5. What was the high there, Alex? Wasn't it like 557?
Yeah,
Okay.
555 or so.
So I had a 550 by 555 bear call spread that didn't fill me. It was only offering like $2 credit. I'm like, I'm $7 in the money. How do I not get a better fill on this trade? I tried to get filled for like $3 and risk 2, and I didn't get filled. I was really bummed on that trade.
Yeah, well, you would have done well.
I know. I was surprised because even when I looked at it like on Thursday morning when the market opened up and it was at 556 or 557, it was only trading for like $1.80 credit. I'm like, this doesn't seem right. This is kind of ripping me off with a trade that's 2 strikes in the money. It's kind of weird.
Yeah. That's man, I don't, it does seem like funny money, man. But like the numbers speak for themselves. Amazon sucked last week. I don't know if you did anything with Amazon around earnings, but man, I will say like Jassy is the worst hype dude ever. I mean, I know like you don't have to Elon, just study some of what Elon says around earnings calls, man. He's like, oh yeah, we delivered 2 Tesla vehicles in last quarter, but we have Optimus Prime robot that's going to like colonize the moon next quarter. So, that's why everybody should buy Tesla.
Yeah.
Amazon's numbers weren't bad,
No,
really.
they weren't. Yeah.
But like Jassy he sucks at hyping up the stock up. They're the worst earnings calls ever.
Yeah, I'm looking at some ratio spreads on Amazon. I've been playing that the April low, like the 160 to 150 zone. I still have some Amazon ratio spreads, 160 by 155, 155 by 150. So I'm playing those April lows. I don't think we get back down to those levels. And like you said, earnings numbers were solid. So and a lot of it too, it's like like Microsoft and Google and Amazon, a lot of it's all in the cloud. Like the cloud-based services, like Amazon Web Services continues to be like this huge revenue stream for them. Same thing with Microsoft and Google. It's like that side of the business is just taking on a whole new identity where it's like that's a major revenue generator. So I don't know why
Everybody who
earnings
doesn't know, like
treated Amazon so
AWS,
poorly.
Amazon wasn't even profitable until AWS. That's what actually made it make money.
Yeah, that's true.
Um,
But it's also changed the whole logistics of the world. I mean,
yeah.
it's not a company I want to bet against. I think, I mean, there's, I don't know. I think it could be imitated but never duplicated, if that's the saying. But Amazon has changed the way that like all distribution convenience. I mean, my gosh, I mean, I think I ordered 2 or 3 things on Amazon this weekend. It's
Oh,
just like
yeah.
at your fingertips. I'm like, yeah, what do we? Oh, we need that. Okay, check, 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 and then done. It's there tomorrow.
I don't even know
It's ridiculous.
how people planned out their goods purchasing before. It's like I just remember something I needed and like, oh, okay, I can get it today, this
I
afternoon.
know.
Cool.
It is really it's really scary how convenient that is.
But what do you do here, right? So Amazon's weird because you have on one hand you have Microsoft, you have Broadcom, you have even Apple, sold off on Friday pretty hard.
Yeah.
I think actually that was probably maybe a dead cat bounce for Apple, but they did rally after their earnings call, and then you have, I mean, out of all Netflix, right? I don't even know. Netflix was selling off. I want to see something before I say. Okay, so Netflix is also below the 50-day, but
Yep.
but what do you do when these big tech companies are dipping below the 50 days? Is this a buy opportunity? Do you wait? Obviously, you don't want to catch the falling knife. Do you
Yeah.
for some support? I mean, for me, Amazon sub 200, that seems like a pretty good deal, honestly.
We look at mags
Yep. Yeah, that
because
that's
that's probably the reason I'm going to hold off until if I want to establish like a mag 7 type position. I mean, you can play the individual stocks, but mags, we're trading a lot like the index. I mean, we tested the 21 last week and we're above it right now, but if we get below the 21, I think we fall between the 21 and the 50.
yeah.
So
You know
if
what's
we fall to, I mean, and if I've got a big fib on my mags as well, down to the lows at 30, the lows around $39, and then up to these recent highs. I mean, even a simple like 23 to 38% pullback pulls us back into like the mid 50s or low 50s. I'd
Mhm.
probably wait and see, like, do we get that as an opportunity to buy the mags? Um, and again, it's like I just want to use that as kind of my gauge because it's weighting all those different Mag 7 stocks. But if we get that pullback,
Yeah.
then what's my biggest dip? Do I still like Amazon? Well, I'll put a trade on Amazon based on mags pulling back. Do I like Apple enough? Do I like Google enough? Whatever stock looks good, I'll probably trade the individual stock. I don't love Meta right now at $768 and Microsoft even at 5. It's like I'm not going to trade a ton of or a ton of ownership type options where I'm like I'll do a ratio spread. That's just really expensive. Netflix ratio spread at $1,100, Microsoft at 533, Meta at 6. It's just too expensive. I'm not going to own 100 shares and allocate that much capital to them. I'll dollar cost average, but I'm not going to do like I'm willing to do a naked put in income, yes, but I don't want to own Microsoft at $500 or Meta at $700. It's too much capital for me to tie up in any one account.
I mean,
No,
have
the
you all
good
seen how much
the,
their cash flow has dropped though in all the mags? I mean, their
Yes.
revenues have gone up, but their cash flow has dropped like a rock.
Has it dropped
yeah,
because they're spending, or is it dropped
yeah,
just because they're
It's
tighter market?
dropped
It's just
because of
spending,
AI
right?
spending is what's
Yeah.
happened. So
And
longer term it'll pay them off, but short term it's going to hurt them.
yeah.
yeah.
But
It is
I don't
wild
think.
to
Go
see
ahead,
Apple.
Alex.
Amazon. Well, I mean, I was looking at Apple too. They're also below the 50. Like this just seems like it feels like it's been so long since any of this has happened. So
Right.
I wanted to observe that. But yeah, Apple down here. Oh, yeah, so the free cat, like, yeah, CapEx expenditures, both Microsoft and Amazon, or actually don't know if Amazon, probably Amazon too, but Meta for sure, are spending a ton.
Yeah.
Yeah,
But the
then
market the
Google,
market
all of
takes all
them.
that spending in a positive though. I think right now the market's like, oh, that spending is good because this is the AI arms race.
Yeah.
And for right now that's what it is and that's what needs to happen. But I think that our energy efficiency is possibly the bigger bottleneck versus like tech can spend all they want, but they're spending on things that might not be handled. Like you can't build out all these data centers without having cheaper energy you know. So I think if and we don't see it yet, but that's possibly the hang up, that's possibly the bottleneck. I think there's fast tracking in the private sector and the government side to get more pro growth and deregulation. But I still think ultimately the big bottleneck to me is like either we we are restrained from this growth that we want, or we are ultimately struggling to do like a sustainable frenemies type deal with China to get the materials and things that we need to like build this stuff out.
Oklo
I
filled that gap, huh?
which Oklo, yeah. Also, really quickly on the whole the trade situation with the world. So Japan stepped in line, Europe stepped in line. Yes, we have something with the UK. Yes, we have something with Vietnam. You know, China's kind of in the background with a pause. I just heard an interesting angle these last couple weeks. So the kind of rush to get like everybody else to jump in line. You know, obviously like nothing's officially inked and officially done, but there's talks happening. This is promising. This is what the market's been going off of since April's lows. But I think it also puts a little bit more pressure on China to then still consider to do a favorable deal, mutually beneficial, but do a deal with the US versus isolating itself. Because if the US is able to get some deals with the Eurozone, with Japan, with our allies, I mean, even if it's by necessity. Maybe we're less
Right.
allies now because we're obviously adding more friction to the global economy, but we're doing deals that are needed to move everybody along. Like the US stays resilient and growth oriented. Everyone benefits from that. If people want to trade the non-US trade this year, that's fine. Obviously, there's some ETFs that are Europe based that have done really well. There's a lot of non-US, instruments, ETFs that have done really well. But
European defense has been since December
yeah,
it's been one of the best performing sectors.
true.
It's crazy.
But again, like, is it sustainable? It's like you essentially have like an austerity driven eurozone that is now for the first time in a decade willing to actually like spend. And what I mean, they've just taken a page out of the U.S. playbook because what have we done? We're spending like it's crisis level times, and it's not. It's clearly like we're at peace. We don't need to spend 6 to 8% deficits, but we do, and it's like we have to. It's like the amount of dollars or leverage that we have to put into something for any type of growth. I think right now we're like either 1.5 to $1.7 just to get $1 worth of growth. Like we're almost double leverage, where it's like it takes that much more to spend just to get the growth out of it.
Yeah.
And I don't think that's changing. And this whole, I mean, I don't know how long this like debt cycle can go on, but the whole world's doing the same thing. So I mean, unless we're all going down together, and this is like, I mean, if you guys have had any conversations on the fourth turning, it's like all that stuff where it's like something's going to
Yeah.
get rebuilt. And it's going to be scary. Like the fourth turning at some point will be awful and terrible, but that's what hedging is for. That's what portfolio protection is for. That's what non-correlated assets are for. There's ways to survive all this stuff. But what's insane is even during a fourth turning, which we've had several times in the last century, even those fourth turning events that can be so disruptive, they offer generational wealth opportunities if you have the cash to invest. So I
Mhm.
think the scariest thing, and I want to ask you guys in your personal portfolios, are you fully invested right now? Because I'm not. Like I'm like
Oh no.
50% cash right now.
No,
Yeah.
I am not fully invested. In fact,
Yeah.
I've got SPY puts out to November right now.
Yep.
So, I mean, I'm about probably 45% invested at
Okay.
best.
Yeah.
And I've got it hedged with SPY puts. So
Yep.
I mean, I'm kind of watching. I mean, I've been expecting this market to correct back about, somewhere between 5 and 10% and just hadn't done it yet.
Yep.
Yeah.
I'm right
I,
there.
I have been like dollar cost averaging, just getting in as we've gone, and even on when we sold off on Friday, put a little bit in, but I'm still maintaining 50% cash just because, hey, right. So the reason I'm still getting in even at all-time highs is it's like it could just it could just not go down, right? Like it doesn't
Yeah.
have to.
Like we blow the
Yeah.
top off before it actually pulls back.
I mean, think about
Yep.
everyone who thought that like I mean, look at all these dips, right? I mean, everybody who thought this was going to turn into this or this was going to turn into it never happened, right?
Yep. Yep.
Like so doing it smart, maintaining if we do get a good dip, like if we do get another correction down to 480 or even down, lower than I mean, I suppose 2023 lows, maybe. Who knows? That's a good I do want to maintain cash for that, but I'm also not just going to sit here and just let inflation eat it away. Even if even in a money market fund, it's still you just kind of I don't know. I feel like you're just kind of losing money vis-a-vis
Yeah.
what you can do with the market. So I'm putting a little bit in it. dollar cost averaging, but keeping dry powder just in case you do have a bigger correction.
For sure.
But I'll tell
Um,
you one play that I'm kind of getting my eyeball on once again. If you throw in Home Depot real quick.
oh yeah. Hey, also I want to talk about that BP oil discovery.
Ah,
Did you hear
um,
about that?
but if you look at Home Depot like on a weekly chart or whatever, you just kind of go and look at how it's performed basically between August, September up through November. And you have to disregard 2020. 2020 doesn't count in anything.
No.
So, but you'll notice that it has a tendency of going up through that time. Hurricane season, there it is. Okay. So, I mean, I think right now it's starting to set up right now to maybe start looking at the old hurricanes again, and it might not be a bad idea to do like I mean, you might have a great ratio on this, Chris, but I mean, if you just want to just do like a big old call spread, if you can do like a 480, no, I mean, a 380, 410 spread for December, get it for like $13 or something like that. That's a $30 wide spread. You can probably pick up, pretty good. If you just want to do outright calls or just buy the stock, whatever it is, doesn't matter. Even if you want to do it the other way around and maybe sell puts on the thing,
Mm.
you could probably do that. It's expensive stock, don't get me wrong, but
Yeah.
I think you're starting to set up here, and if we can get above that, 381 area, I think it's going to have a tendency to seasonally kind of take off once again.
I like that.
I like
Yeah,
that.
Home Depot and Lowe's.
I
I
hate
like both of those.
Lowe's. Stop.
Well, stop. Well, but they both have good. I mean, technically, I mean, I would love to say if I'm really going to participate in something Home Depot wise, I would love to get something at like the 285. Like if I'm saying I want to own Home Depot, either I call the April lows around 326, or I look back to the 2023 support, 2023 support, back into
Mhm.
2022 support. That's all the way down to like 285. So
Right.
if there's a way to position for that. That would be to me like my preferred ratio spread as far as like putting out puts to like own the shares. Let me see let's see if I went out to like the end of the year, even into January in HD, what does that give me? I was looking today at some futures trades. Like I said, I sold puts last week on the SPY. I should say did a ratio spread in the SPY. If I see the implied volatility go up a little bit, if I see the VIX get back into the 20s again, I'm not too far removed from last summer, like July to August last summer, we had that big Volmageddon event. I don't
Hmm.
think we're going back to 50 or 60 on the VIX, but I think even if the VIX goes to 25 or 30, that's another spot to like sell some premium, take some bites, position for a correction, and like I would be surprised if the market is only going to pull back like 3%. We pull back 3%, go to all-time highs and keep going. I'd be a little surprised. But if we pull back 5%, okay, let's play the 5% dip. Let's play the 5 to maybe 10%. This is a
Hmm.
good time of year where like Europe's on vacation, things are a little bit lighter, liquidity and volume. Currencies last week were kind of crazy. Like the dollar had a great like 6 day stretch and it got smashed on Friday. The
Yeah.
yen, the yen was a crazy currency pair on Friday. I had some actually really lucky trades where I like leveled into the dollar yen and I got paid out in a big way on Friday, which was pretty surprising. I usually like never level into the dollar yen, but it did. It worked out. Anyway, Home Depot. I'm gonna go out here to let's go January of
Want to share your screen?
2026. Yeah, sure, sure. And this might not offer a bunch of premium, but just the way that Jeff was talking about, this is what I'm just immediately thinking about for a trade. So if I go HD, here's the chart. So I look at the April lows. 326, not a bad spot. Back down here to like the 280 levels. So there's two spots I trade it. If I go 325, let's actually check the fundamentals here as well. So HD, as far as discounted cash flow, where are we supposed to be? Where can we be? I mean, Snowflake's okay. Debt, insider selling, earnings forecast to grow, reliable dividend. Okay, fine. Not super excited about that fundamentally. Price to earnings 25 times. Meh. I mean, fair value 315. So that's why I'm not super stoked about calling the April low as like, okay, I'm going to own it here at 325 when discounted cash flow says 315 is fair value. So to me, owning this would be anything in the 285 to 280 zone. Let's see if I can create a trade that gets me there. So the premiums at the 280, actually, I think I'm going to take this trade. 290 by 280. Go out to January. If I buy the 290, sell the 280, that's a 10 wide ratio spread. I can still get $1.78 on this trade. This one's good for probably margin accounts, not cash accounts for me, but margin accounts. I get $1.78 income. There's about a 98% chance of profit. My assignment risk is about 5%, which I'd happily take that and own it if I do an at the money. If I get assigned on the stock and I have to flip this thing, I can get anywhere between $9 to $12 of credit on a 30-day call option. So if I own it, which I'm owning it around those like 280 lows, I think that's going to be at least a reactionary level. So if we did drop here, I think I've got a chance to repair that for probably $1,000 pretty easily. So guys, I like the trade. Jeff, I'm going to give you credit for it. I'll buy you a cup of coffee if I get to $180 income on this one. No, but I like the trade. So I'm going to go out to January 2026. That's the January 16th of 2026 expiration. It's out 165 days. I'm going to look to buy the 290 and sell the 280 with 2 contracts. So it gives me about $1.80. Let's try $1.85 here.
So
I'm
you
going to
get
go.
$1.84.
Yep. I'm going to try to get like $1.85 down to like $1.80. If I can get $1.80 or better, I'm happy. If I get $1.85, that'd be generous. Let's see what the market gives me. So I use these margin
Hey,
accounts.
Chris, can you also explain to everyone what a ratio spread? What's the
Absolutely. Absolutely.
problem?
Yep. So what this is, a ratio spread to me is anytime I take a ratio spread, there's 2 ways I manage it. One is I'm willing to own the shares, so it's kind of like a fancy naked put. So here's how it looks if you can see my writing. So I have a naked put, okay, or I like ratio spreads, a ratio spread. Okay, so naked put would be, you're basically expressing to the broker, I am willing and obligated to own the underlying at X price. So if I sell the 280 put, okay, that 280 put, if I just do a naked put, I can get $2.15 credit. Okay, so that's just going to walk through. This would be $2.15 credit at the 280 sell put. Okay, a ratio spread is I am willing and obligated to own the underlying at X price, which is going to be my sell puts, but I want to reduce the volatility and also have a profit trap.
You want it to go down, folks, but not too fast.
Yeah, if price falls to my sell put level. And so with the ratio spread, ideally is price can fall, but if it falls slowly and kind of orderly, we may see greater than the sell put premium. Okay, so here's how the math works in this trade. If I just sell a put on Home Depot, I get $2.15. That's cool. So I can take the 280 put. So a 280 put, $280 put minus $2.15. So if I get a sign at Home Depot, I own the shares at $277.85. Great. But if I do a ratio spread, I take a 290 minus 280 is $10. So if I get assigned at 280, I take away a $10 credit because that's actually a $10 wide profit trap, and I still get a $1.80 credit. I own the shares on a ratio spread at 268. So that's a $9 improvement on my break-even cost, and I potentially have a $1,000 profit trap that I can work with. Again, the common denominator here is I'm still willing to own the shares. Now, if you don't want to own the shares, then I oftentimes, if I don't want to own the shares, like i.e. something really expensive like Meta's $700 some, I don't want to own the shares. So I would do like maybe a 300% stop loss. So if I pulled in $2 and is trading for, $6 or $8, I close out of the trade. I just take the loss. I don't take the assignment, right? But I'm willing to own the shares. So I'm going to take the trade here. See if I can get filled now it's trading for $1.90. Ooh, all right. I still like to trade $1.90. Let's see if we get filled here. So $1.90. $1.90 not filling. Do we have earnings on Home Depot, by the way? Am I overlooking something? We have earnings on the 19th. That's fine. I'm going all the way down. I'm going to freaking 280. So I know there's risk in the trade, but let me see if I can get filled for $1.90 here. So $1.90 pending. Let's go back to HD.
So while you're doing that, Chris, I'm just going to show people how this looks.
Yep. Can you do like a risk graph? Do you want me to, I can show that too. I think that's a good way to look at it.
That's what I'm going to do. Yeah.
Cool. I'll stop sharing. You can take it.
Here you go.
Yep.
So this is basically the trade that Chris is looking at, right? It's the 16th, right? You're doing the January.
January 16th. Yep, correct.
So 290, right? So you buy the higher one, you sell the two lower ones. And then this is the payoff diagram here. So as you can see, as time progresses, so right, you want it to fall, but not fall too fast, for your maximum credit. And then it goes to 320, you collect that 184 or so by January 26th. That's the graph doesn't look, I don't know why it doesn't look great.
Just do the range. There you go. Yeah, that's what I'm looking for.
Yeah. So this is the graph. So
I'm still not getting filled here, but I hopefully I get filled for $1.75. I'm still going down penny by penny. Come on. 175. I guess I'm willing to accept $1.70, but if it's not $1.70 or better, I'm not going to take the trade. So I'm at $1.74 right now. This means I'm slightly below the mid price, which is a little disappointing. I know there's some earnings, probably volatility built into this thing.
it's wide. Yeah, it's super. What is it?
It's a bid ask is like over
volume.
$1.10. Yeah.
Yeah, man, the best trades. Sometimes that's the problem, folks. Sometimes the best trades
Jeez,
can't.
I'm not even okay. I just got filled. $1.70, I got filled. So I'm gonna replicate this, try to get this filled for all my accounts here. So let me go through this, Alex. That image is perfect because right now, like I said, there's about a 98% chance of profit that this is not assigned. Like these are, I'm talking like this is a 6 delta put, which
Yeah, I
is
mean, look at
super,
the
super,
chance of
super out of the
profit.
money.
99%. It's actually better than 99%.
Yep. So to me, it's an income trade where I expect to make the $170 income. I do this on 9 accounts. I make, whatever, $1,000 roughly, and maybe more like $1,500. So that's a little bump to the account. That's fine. I don't think the assignment would really be a big deal. I mean, if I got assigned, the stock is going to drop how much? We're trading at 380. We dropped to 280. Like we got to drop $100 on the stock.
And
Um,
then don't forget that we get that, folks. That's what's cool about this is that when your actual net cost would be 268.20 or something, right?
correct. Yep.
So you're going to be able to, even if you get assigned, and it doesn't keep on dropping, which is always the risk, but of assignment just keeps on going. But you could flip it back immediately
Correct.
for over the price that you're actually paying for those shares.
The ability to repair it is pretty easy in a ratio spread. When number one, I'm going far enough out and down far enough where it's like I'm calling a pretty key level. We've had multi-year support at that 280 handle. We'd have to drop $100. It's like, look, if the broader market stays resilient, Home Depot's probably not dropping $100.
Yeah.
If the broader market goes up, this is going to be easy income. If it goes down, okay, fine. Anyway, I'm just going to keep getting filled here. I've got 1, 2, 3, 4 accounts. I've got a few more to do. I'm getting filled at like $1.70 to $1.73 on a lot of these trades. I'm satisfied there, I guess. I wanted $1.85 at first, but that's just not realistic, I guess.
Yeah, if it's above, Jason, if it's above 290, the ROI is just the premium that you got for it.
Yeah. Ideally, the trade is what I expect to make is I expect to make about $170 on the trade.
Yeah.
That's my expectation. The profit trap is if price drops, and let's say we're testing like 310, 305, $300, it's a possibility that out of the money long put could maybe generate some bonus profit. But by expiration, my profit trap, as Alex is showing there, if we're at 289, 288, 287, 286, 285, 284, anything between that 290 and 280 zone, that's $100 per point. So I pin this thing, if I'm really lucky, and this is rare, if I pin it at 280, that's a $1,000 profit trap on top of the 170 credit that I got.
And
So
that's so at a certain time period, right? Or is that
that'd be it by expiration.
Yeah, okay.
Yeah.
So you have to get it by expiration.
Correct.
Yeah. Pretty cool, man.
It's a great strategy. I actually talked about this morning in my daily profit plan room. Thanks, David, for posting that in.
54 for you. Debit. I don't think you're doing that.
No, I'm getting $1.70 credit on the trade. Make sure no. It's the 280 is 2 puts. I'll type it in. Don't try to type in my trades for me. Who's ever doing that? So this is Chris's trade. I'm posted for everybody. Chris's trade on HD is a 116
I'm just going to plug in my laptop real quick.
Okay, expiration. I'm buying the 290 put with 1 contract. I'm selling the 280 put with 2 contracts. That's what you probably did incorrectly. $1.70 credit. That's the trade I just took.
You have to be careful if you're using toss. If you use the back ratio, it'll flip it. It'll do the 2 buys at 290 and 1 sell at 280. So watch out for that.
Ah, okay. So you think or swim, be careful on that.
Yeah.
Yeah.
Yeah. People will
Okay.
click that back ratio and it'll do that to you.
Yeah,
So
that's not good.
you gotta flip that
That's
around.
a huge. Yeah, the back ratios have big fat dead zones.
Yeah.
Right.
Okay, I'm still getting filled at 270, so that or 170. That seems to be a pretty good fill for all these.
I got filled at 176.
Well, look at you, Jeff. You trying, well, never. I'm taking that cup of coffee back, dude. You owe me a cup of coffee now. That $6 surplus you got. Okay.
Let's see. Let me see if I can get filled at 181.
All right. So I got filled. I'm going to get this in. This is going to officially go out to my Project Options Edge classroom. I'll post that in Telegram, but I'm going to add this to my tracker, and it's a good trade.
So
Okay.
I love that. Yeah, that's very cool. So one thing I want to wrap up here with is do what what are we, I know we just put on a trade. So do we trade? My question was, do we trade? Do we wait to see how this month, not at this month, but how this first few days of the options expiration cycle plays out? And or do we just, what are we waiting? Are we waiting on the sidelines? Are we diving in now that we're in August? What are we doing here?
I think that I need to be positioning. I'm going to be a little bit more active. I'm not going to be aggressive per se, but I'm going to be active. If we have like the VIX spiked at 20, I'm going to sell some premium. If the VIX proves it wants to go up to 25 or 30, I'm going to sell some premium. I'm taking bites right now. I'm not going aggressive. I still want cash. That's what I was asking you guys, like how much cash you guys sitting on and waiting on the sidelines. Like, look, if we melt up further to all-time highs at 7,000 SPX and I'm still sitting on 50% cash, that's fine. I mean, I'm getting unallocated cash at like 4.1 to 4.3%. If you guys trade BIL or hold cash in BIL, it essentially generates like a 1 to 3 month treasury mix. It's not the greatest because obviously like you sit into it for a month and it has to kind of time has to pass. But if you held BIL for an entire year, you're going to get about 4.3 to 4.4% on unallocated cash. So that's not a bad place to be as far as I've got cash. What do I do with it? Park it BIL. That's a safe place to go. It's like a 1 to 3 month treasury mix, and it's just yield. You're not trading the direction. You're not. It's just yield. So that's one way to kind of safely park your money to just let it get a small yield. Like every month you're getting like 0.3 to 0.35%. That's better than nothing, obviously. But if we get a spike in the VIX where we go up to 25 or 30, I'm just going to take more bites. Cost effective ways to do it: debit spreads and credit spreads. We have dips. My waterfall income, double ups, couple of my services. We'll be like aggressively playing the 50-day moving average, the 100-day moving average, some of those big support levels we've highlighted in the SPX. So
Yeah,
what
it's
you're
kind of exciting, honestly. I mean, you got finally some pullbacks happening. We got some of the big tech companies moving under the 50-day. I mean, this is not, it's like if you were waiting to buy on the sidelines, and it's like, I just don't feel like it. Well, now there's some other opportunities happening.
correct? Yep. Okay, so that trade is in. Like I said, Project Options Edge. I'm throwing that in for the service. You guys all saw it here. Good stuff.
So at first,
Yeah, go ahead.
I was just saying everybody here saw it first.
Oh yeah, that's true. Yeah, right here. That's it's nice. I wanted to ask on the thoughts of like, okay, I'm kind of playing like selling premiums, taking bites on little dips. What are you guys doing? You nibbling or you getting more aggressive? You think we're just, well, I don't know. I'm just curious what your guys' plans are.
I'm how's the best way of putting this? I don't want to say I'm day trading more. How's that?
There you go. Yeah, yeah.
I
Even
mean, I
even that's
mean,
totally
I
fine.
I'm short-term trading this thing. I'm not trying to figure out, what we're going to be in the middle of September or October or whatever it is.
Right.
I'm still cautious to the long side, and I like just kind of trading off the open, getting long if they're heading up. And the thing is about this market, a lot of times we'll get to that European cash close, and once Europe is out of the way, they turn this thing back around and dump it back off. I mean, I've seen that several times. So as long as I can get something over the next couple of hours, I'm good. And if anything, I'm doing credit for the week, not going out too far out.
Hmm.
So I'm doing Friday expirations each and every week. So I'm doing the credit side and short term, no, what directional, I'll put it that way.
I like that.
Yeah.
I do have some trades running. We're at 63.12. I've got a 63.20, 63.20, 63.25 lines today that I'd like to see defended. I just did some credit spreads this morning based on the VIX rule of 16. So hopefully we don't cross above 20 and 25. If we do, I'm going to take some more contracts and size in, but between like 20 and 40 today, 63.20, 63.40, to me, those are kind of my resistance levels I think are going to stick. So I'm selling those today.
Nice. Yeah, I'm
Awesome.
selling premium every like just like what Jeff said. I actually honestly, Jeff, like doing exactly what you're doing, selling weekly premium. There will be some new weekly premium plays coming in the Telegram this week, folks. Or not this week, today, later for today. So be sure to check those out. I'm day trading, futures, just MES every day. Did it this morning on the breakout. Just going with the 920 crossover, and didn't even have to get that today. It was worked out well. And then also just honestly, like I feel like until this exuberance just ends, man, like today we've just been using my unusual flows app that I'm working on. I got the prototype, and if you're in my Telegram, you've been seeing that, but we're just following the unusual flows. And we got American Eagle, we got like a 30% in like 20 minutes. I don't know if anybody else is watching this that got in on that trade, but we got one trade open on Oklo. We're just doing these like, we're just going over these like just following these option flows, and until this exuberance ends, right? Just kind of playing those fast moving, plays that these options don't cost a lot. We're maybe sometimes over 100, but we're just playing 80 cent contracts, 50-cent contracts, and just trying to get some quick pops. So but yeah, it's the same concept, right? Not doing any longer term bets, really, just shorter term.
Like it.
Yeah.
Yeah, I'm blending. I'm doing a combination. I think that I'm pretty. I'm going to say I'm tilted bullish for the end of the year. I think that this August September is a perfect window to pull back. I think that the market is. I mean, think about how nasty the market turned last week. It's like, okay, we had a big pop on earnings for Meta, Microsoft. The market gaps up. It was the perfect time to rally right into July's highs and finish the month positive. And then like that, you could see that it started to crack a little bit for July. Volatility started to spike up. Thursday, Friday were pretty nasty sellout days, but it was like right at the end of the month. August, September is a typical seasonality pullback window. Um, Jobs, it's like all the stuff just kind of hit. But what happens in September? I mean, the Fed is, if what do we think? I think the Fed is going to cut rates.
Oh, it's
And
80% likely
right.
now to cut
So
rates.
it's like
Yeah.
they're either going to cut 1 to 3 times. So, and I mean, the Fed is going to be there to kind of, curtail this like weakening job. Like everyone's now, of course, everyone says it after the fact. Oh, the jobs number is so bad. The Fed should have cut. Well, they freaking had FOMC Wednesday. They didn't know the jobs number on Friday.
Right.
So they're not just going to emergency cut like the day of non-farm payroll. So now they have to wait to September. That's the next Fed meeting with rate. I mean, I don't think they're going to do anything out of the norm, but they're likely going to cut. And even a sell-off that we might experience is still going to be met with, okay, we have a government that's going to spend, that's pro-growth. We have a Fed that's going to be cutting. I mean, as long as inflation isn't running rampant, the market can tolerate sticky inflation because it has been. The market's up at all-time highs, and we've had sticky inflation for 2 years. But
Yeah.
can the market tolerate a big jump in inflation? Of course not. Can the market tolerate a big jump in yields? Of course not. It's the rate of change that catches the market off guard. But if it's like slow and steady and persistent, sideways, little up, little down, the markets can always make those adjustments. So I still think even with a dip that we might see, the Fed's going to be cutting 2 to 3 times by the end of the year and rolling into 2026 when Powell is done or if he resigns early. It's like that could be disruptive. But I don't think the path is austerity cut, scare the world, global trade war. I mean, I think it's just the US faces a bottleneck, maybe faces a policy shift in 2026 if Trump and company lose the midterms. But until then, the runway to me looks pretty much the same as our April pivot. It's like just more of the same. Maybe some
Yeah.
sideways here, maybe some pullbacks that make sense that are much needed. But I think it's still like just market just wants to grind ahead, grind higher.
Yeah, and OPEC increased production by 500,000 barrels a day. So that's what
Okay.
Okay.
brought your energy markets down. So watch out for
Yeah.
that.
There you go.
Anything on the copper last week, guys? That was like one thing I was surprised on Wednesday. Copper had one of the biggest single day runs and one of the largest weeks ever.
Yeah, that was tariff time.
25%, yeah, 25% in HG in a
Yeah.
day.
Yeah, that was the big old tariff time. But when the tariffs came out back in April, they had a 23% dump. Looking at
Yeah.
your price from high to low there on both of those, they both dumped almost about the same. One thing I was watching is see if copper could stay above 440, and it has. So
Okay.
that was its little spot of, can we get above it? Can we get above it? And finally it did. But now we're back down there again. But if we can get back above 460, I'm buying no CopX, no CCJ, all those guys.
Yeah, makes
Oh,
sense. Just to really disrupt the move. That's all.
yep.
Yeah, that's crazy. Pretty wild stuff. Yeah, well, so I think just to cap this off, it's like, look, VIX higher, finally above that 50-day moving average. Who knows if it'll stay above that? But VIX higher, more of opportunity, more volatility. There's no you don't have to run. You just have to be more cautious and conscientious. It's not throwing a dart anywhere on the board and maybe everything wins. Which I do think has been kind of the regime we have been in. But there's plenty of opportunities. There's going to be plenty of good buying, long-term buying opportunities. Plus, because of the volatility, trading opportunities as well. So
Yeah, agreed.
don't be fearful. Don't read zero hedge, folks.
Oh yeah. The
Normal.
doom and gloom is everywhere, man. It's
Yeah.
so much noise. It's so much noise. Like just look, like you guys are doing, talking about like short-term trades and short-term premiums. I mean, I've got a mix of short, medium, long term, but like my long term is literally like maybe out to the end of the year, December, January, where all the flows are typically pretty bullish. Maybe
Yeah,
Q1, but it's like I'm not doing anything through like next summer. It's all out to like December to January. That's kind of like right now my window is if I'm going long term, it's out to the end of the year. Short term is daily and weekly and just income. Eliminate a lot of the overnight exposure, get rid of the outliers, tighten up risk, and also have cash at the ready to deploy when you get a good opportunity. Because that's the thing is, if we drop another 3 to 5% and we get down to like a 7 to 10% correction, the opportunity to participate in that dip is going to be great. Think
Yeah.
about this. We've been waiting for like 60 to 90 days to get a dip. And if we
Yeah.
yeah,
get one, it's like I want to participate, not think it's like the
absolutely.
top is in.
Yeah,
I just don't think the policy shift is going to just go that differently. I mean, the markets like this optimism. The market likes this hype. Until we like bottleneck it where it shows there's no growth left, or until the consumer actually breaks, until the housing market breaks, and the labor market truly breaks, and until those stools are like missing legs, the market's going to keep humming along. So it's a lot of noise, man. Zero hedges noise. You get all if you're on Twitter and X, it's tons of noise.
It is.
Newsletters are tons of noise. I mean, even look, like that's why we do sessions like this. We're real traders. Like we've got to be in the trenches. And I just think if you're focused on the doom and gloom, you're gonna miss what happened back in April. You're gonna miss that crazy, bottom and the melt up where it's like, how nice would it have been to position for any extra cash to be invested in April at a 20% discount? The
Or look
best, the
at
best entry,
look at
and
this. What if you were bullish, or sorry, what if you were bearish in 2023 and you thought this is when the roosters are coming home to roost?
right? Or
I
during COVID. But I mean, my
mean,
one of my best friends was like, dude, I'm so bearish right now. It's like he's not a trader. He's a freaking science guy. And so he's bearish in 20 think I mean because it's California and he's in science and so this is COVID and the whole world's going to feel it. This is I mean he has from 2020 to now he is so frustrated with just the entire market. He's like, this is just not real anymore. I'm like, it never has been. The markets have never been real. It's never the real economy. It's a parallel of the economy, and the markets are always priced in and the sentiment swings and what this is a future thought here, but when AI is telling everybody that this is what the market should be doing, I mean, how do you play a contrarian AI? If everything that data is showing is like it's supposed to be factual and it's supposed to be black and white and everything says it's bullish. Is there a contrarian play when every AI reading is the same?
man, that's a good question. I don't, and that it gets to what I say oftentimes. It's like, look, whether you have these very smart engineers creating AI that are now
Mm-hmm.
doing the market, the physics majors go into the markets. They don't go into
Yep,
nobody makes any money doing physics. Who cares
that's true.
about
Yep.
dark matter, man? These guys are making algo, quant algos. So look, the whole thing is like now comes the caveat. Black swan events do happen,
Yep.
but if you look at black swan events, COVID, 08. You know, over even just going farther and farther back in US history, like, yes, things go south, but then they recover. There's a lot of money, folks, invested in making sure everything just keeps on going up. So
Yes.
there's corrections and there's people that want to rebalance, and sometimes those corrections are planned, to some extent, just in terms of rollover and the way the big funds maybe do stuff. And then sometimes they come out of nowhere and people have to readjust, and you get this animal spirits going. But look, don't we're not Michael Burry. I don't pretend to be Michael Burry. I don't think anyone here is, right? We're
Yep.
just there's a lot of smart people with a lot of money, like a lot of money, making sure this thing keeps on going. So yeah, there's gonna be dips, 3%, 4%, 5%, 10% corrections. But just, don't stop saying it's all fake. It is all fake. Like Chris said, it's all fake.
Yep.
It goes up into the right fake.
Play the game. Play
Yeah.
the game. Yeah.
Yeah. Now
So
with volatility though, like I mentioned, like there's always good stuff. In the markets with volatility though, right? Stocks move rather than just like a straight line like you see here. They move more like, well, waves, right? They go up, they go down.